Vanguard's 2019 economic forecast to include stock and bond returns too. That's what we're going to talk about here today with commentary from yours truly, your good old buddy Josh at Heritage Wealth Planning. So as always, if you like what you see here, subscribe, comments, thumbs up, the whole thing helped me immensely with the YouTube algorithm. So don't forget to do all of that. So let's dive right into it. Have I ever told you that I like Vanguard and I like the research they do? I don't think I ever have. So if I haven't, I do like Vanguard and the research they do. And my number one thing of Vanguard, which I like the best, is what we're going to talk about here today, which is their end of the year forward-looking synopsis of what they see the markets are going to do, the global economy, the global markets, the U.S. This thing is just, I love it. I don't agree in totality with it, and I'll share with you my thoughts on it. But man, this is the number one piece of research I look for every single year, just because it's not prescient necessarily, but it does have a lot for you to chomp on as you're planning for your own financial planning. Now, frankly, what would you do differently based on this? Nothing. I mean, at the end of the day, it's meaningless because just because they say this is what they think happens, it doesn't mean crap, pardon my French. It just means at the end of the day, this is what they think. But at least it gets your thinking hat on, and that's always good. So let's dive right into this, my friends. The Vanguard, there we go. The economic market outlook for 2009, down but not out. And I just chuckled when I first heard that. And I have these going back. I think I first found the Vanguard one in 2011, I think, maybe 2012. And it's been fantastic. So we'll break this up into sections here because there's, 44 pages, I think. 44 pages. We'll break this up in sections. How I want to do this. So I'll break maybe 2 or 3 videos because I don't want to kill you with time. Let's see. We got 9:09 right now. So I definitely don't want to go more than, say, 10 or 11 minutes on the first part. So we'll give you the synopsis, then we'll dive into it deep, and we'll just see where it takes us. So maybe watch the following videos as well. I'm not sure how this will go. But anyway, it's a lot of good stuff in here, and you need to read this for yourself, or if you just want to listen to me in your car, you can do that as well. So they put this out in December. Just the other day. In fact, a good friend of mine from Vanguard is the one who said, hey, this is out now. So look, I know a lot of people over at the VG, Vanguard Group, lots of people, lots of good folks up there for sure. Anyway, he's the one who let me know that this had come out because he knew that I liked it. All right. As a global economy enters its 10th year of expansion following the global financial crisis, concerns are growing that a recession may be imminent. Although, now, let me just real quick. Imminent is not immediate. I cannot stress this enough. Imminent does not mean it's going to happen tomorrow. Immediate means it's going to happen like right now. Imminent means it's most likely going to happen, but we don't know when. I get this all the time where people say, oh, they said it's imminent. Yes, it is imminent. We are imminently going to run out of fossil fuels. That is imminent. When does that happen? Does it mean imminent is, in this case, 2 trillion years, 2 million years, 2 years? We don't know. It is imminent going to happen. It's going to happen at some point. We don't know when. Immediate is we're going to run out of fossil fuels immediately. No, we're not. We're just not. Now, again, it depends on your time frame. If your time frame is, since the dawn of the Big Bang, if your time frame is that, then it is immediately we're going to run out of fossil fuels. If your time frame is in the context of a generation, it is not immediate, even though they're both imminent. It depends on what your time frame is. It just drives me crazy when people get those two wrong. Although several factors will raise the risk of recession in 2019, a slowdown in growth led by the U.S. and China with periodic growth scares is the most likely outcome. In short, economic growth should shift down but not out. Previous Vanguard outlooks anticipated the secular forces of globalization and technology disruption, which would make achieving a 2% inflation in Europe, United States, Japan, and elsewhere more difficult. Now, the reason we're using the 2% inflation is what the Feds have targeted. All right. And that goes back to what Bernanke. I was listening to a podcast actually the other day. It was actually pretty interesting how they came up with that explicit 2%. I'm trying to show it to you. The podcast, it's a Planet Money. And so as you can see here, these are my podcasts. And if you can see Planet Money right there. And they had a synopsis of how they came up with the 2% forecast for inflation. It was almost back to the envelope stuff. It's frightening in some way how much power the Fed has given what it was frightening. But all right, whatever. It is what it is. So it's 2% is what the target rate of inflation is for the U.S. Federal Reserve. And Vanguard says we think it's going to be difficult to achieve. In 2019, we do not see material risk of further strong rises in core inflation, despite lower unemployment rates and higher wages. This is because higher wages are not likely to funnel through the higher to consumer. This is likely because higher wages are not likely to funnel through to higher consumer prices as inflation expectations remain well anchored. So just keep that in mind. All these people saying hyperinflation, Zimbabwe, blah, blah, blah. Vanguard's not expecting that. That doesn't mean they're wrong. They're going to be wrong or not going to be wrong, but they're not. They're, in fact, they're saying it's going to be hard to even hit our target of 2%. You don't know about that. As inflation moves towards target, financial stability risks rise and unemployment rates continue to approach or drop below estimates of full employment. Global central banks will stay on their gradual normalization path. In the United States, we still expect the Federal Reserve to reach terminal rate for the cycle in the summer of 2019, bringing the policy rate range to 2.75 to 3%, which is going to be what they're shooting for in terms of that's their federal funds rate. I can't remember what the rate is, but that's the rate they're shooting. Is that the federal funds? I don't think it's federal. I can't remember. Anyway, roughly 3% is what the feds are shooting for in terms of their interest rate target. So they expected to get roughly 3% before halting further increases in the face of non-accelerating inflation and decelerating top-line growth. Other developed markets, central banks, though, will only begin to lift interest rates from post-crisis lows. So I want to chomp on that a little bit. So two things going on here is that first and foremost, if they're raising the rates to about 3% target, I just can't remember the Fed. I just don't remember what the rate is for their target in terms of terminology. But if they're going to hit their 3, Vanguard says, look, they're not going to halt. They're not going to raise any more after that because of decelerating or at least non-accelerating inflation and decelerating top line growth. We saw that in the last economic report that just came out last week that we had a lower, still 155,000 jobs created, whatever. I mean, that may or may not, but who knows? I mean, when they revisit those from previous months, it seems to boost them, but we don't know. We saw some concerns on growth relative to what it was the last quarter. So we shall see. So Vanguard is saying, look, the growth will not level off, but kind of instead of going like this, it's going to go kind of like this. And that's a decelerating growth. And then when that happens, that means there's less risk of inflation. Thus, the Feds are less inclined to keep raising rates and blah, blah, blah. And we'll dive more into that as we go into this 44-pager. I'm not going to read it verbatim, trust me. With slowing growth, disparate rates. Oh, and I want to talk about this too. Don't forget, the developed market, the European markets, all right, let's just use those for example, and not even talking Japan here. The European markets had NIRP, negative interest rate policy, NIRP, N-I-R-P, NIRP, negative interest rate policy, which meant after inflation, you lost money by buying government debt. All right, that was negative interest rate. And they didn't want you to buy their debt. They wanted you to put it in assets that could appreciate, real estate, stocks, whatever, manufacturing product. I mean, you name it. So you had literally a negative interest rate. You lost money by buying a 10-year German bond, for instance. All right, if you bought a 10-year German bond after inflation, you had less money in your account than you did before the 10 years are up. So you put $100,000 in there, and in 10 years, you actually had less than $100,000, not just purchasing power, but you actually lost money at $99,000. And then you factor inflation on top of that, which was minimal. But still, they're saying you are losing money by investing in German longer-term bonds. And that was, basically throughout Europe is the negative interest rate policy. And so what they're saying here is other developed market central banks will only begin to lift interest rates from post-crisis lows. So again, this is where I always chuckle at the idea that the dollar is everyone's going to drop the dollar. I mean, so it boggles the mind. I could go to Germany and buy a 10-year bond and literally lose money, guaranteed to lose money. Or I could go to the U.S. and buy a 10-year bond, and right now the 10-year bond is at, 2.85. All right, so what would you rather do? Go to Germany, lock up your money for 10 years and lose money guaranteed, or go to the U.S. and lock up your money for 10 years and guarantee a 2.85% rate of return? And the answer is, of course, you're going to go to the U.S. So as long as the demand for our bonds is here, the demand for our dollars will continue to be here. And just as long as the demand for our dollars is here, you're not going to have hyperinflation. I never understood why people get so caught up in this idea that the U.S. dollar is going to lose its preeminence among the world economy. I mean, not if the interest rates are significantly higher here and a safer bet than they are anywhere else. Our bonds will be in high demand, and that does lead to dollars. Is there a 100% correlation? There's nothing, never 100% correlation. But as long as the people are willing to invest in our markets, i.e., through loaning money to the U.S. government, which props up the value of our dollar, you're not going to have runaway inflation. And you're not going to have the dollar losing its preeminence among the global economy. It's just not. And right now, again, and I don't know what the German, I don't even know what the German bond's called anymore, the Bund, something like that. But the 10-year German bond, as long as that is NERP, negative interest rate policy, or even if it's at 0.25, no one's going to buy that over the U.S. No one's going to do that. They're going to do the U.S. because the U.S. bonds are much, much higher. And I don't get why people don't see that. And so I have no concern about hyperinflation. I do have a concern about inflation, but not hyperinflation here in the U.S. And I certainly don't have concern about the dollar losing its strength. Where else are you going to go? Where else are you going to go? All right. With slowing growth, disparate rates of inflation, and continuing policy normalization, volatility in the financial markets is likely to accelerate. Long-term, our 10-year outlook for investment returns remain guarded, given the backdrop of high valuations and depressed risk-free rates across major markets. And depressed risk-free rates are just what I said. The 10-year German, whatever Bund, I think is what it's called, is literally paying you nothing to own it. And so that's a depressed risk-free rate. So where are you going to put your money? And that's the issue here. Well, you're going to put it where you can get some growth or at least some earnings from it for sure. And that would either be in the German equity markets, the German corporate bond markets, or the U.S. bond markets, or U.S. equity markets, or real estate, or whatever you name. But that's their concern, is our 10-year term outlook for investment returns remain guarded, because part of that outlook would be on bonds as well. All right, so and here's the authors of the Vanguard study, and I don't know any of these people. I'm familiar with Keen Wang just because I've read her stuff before. I'm not sure if I read it through Vanguard or just SSRN, Social Sciences Research. Now I don't remember, but I'm familiar with her. I'm not familiar with any of these other guys. It doesn't mean anything. But here's Joseph Davis, who's a chief economist at Vanguard. And if you go to the list here of they got a lot of research people. They got masters of science. Odd that they have CFAs as their senior economists as a CFA as opposed to PhD. I don't care. I just don't. But I find that interesting that the PhDs and the CFAs are kind of consolidating now for investment research / global economic outlook. And you know, it's not a CFP at all in there. So I'm telling you right now, if you're looking for a financial advisor, and who actually advises you on finances and your financial planning, a CFP is who you should look for. If you're looking for a person to manage your money on a day-to-day basis who's looking at it, a CFA is who you look for. And the reason you tell is because, look, there's not a CFP here. Lots of masters of sciences, and I don't know what they're masters of science in, but PhD, CFAs, and that's all you see. So, all right, let's go to part 2 of this. We'll dive into this a little bit deeper. And so don't forget to subscribe, and we'll see you next time. Don't forget to go to the blog at heritagewealthplanning.com.